Welcome to the Nebraska Soybean Board Weekly Market Roundup, being brought to you by Nebraska soybean farmers and their checkoff. I'm Susan Littlefield. As you can see, we are on location this week at Commodity Classic, which has been underway in Orlando, and we're hanging out in the booth with the folks at agmarket.net. I wish I could kind of pan over. We got a great audience, got a couple questions coming from folks here in the audience that are going to want to know about December corn, so we're going to take a look at that. We're also going to take a look at some of the other issues that we've been seeing throughout the market trade. Lots of things to look at on this week's episode.
Imagine a future fueled by soy-based possibilities. A future where creativity and productivity live together under one roof. A future that takes you from point A to point B to point Z, all while ensuring brighter tomorrows for our next generation. A soy-based future? It's already here.
And welcome back once again. As you can see, Jacob Burks joins us and Brian Splitt. They're both with agmarket.net. And gentlemen, let's kind of start out first. I'm going to talk to you first, Brian. Is the struggle that we saw in this wheat complex this week, I think, has maybe caught the attention of a few?
It has. We've seen a really large break to the downside. We saw hard red wheat values trade below $8 a bushel, and not just by a little bit, which we saw back in August, but substantially below $8. And so my concern there, and I've been talking about that for several months, is looking at the continuous chart for wheat for hard red. We saw the same highs made in 2008 that we saw last year after the invasion of Ukraine. And once the market broke down below $8 a bushel, we continued to press down to $6 very rapidly. Hopefully that's not the case, but I think you have to be aware of what the market has done previously from the same price points and what it could do in the future.
Did it come as a surprise that it took as big of a drop as it did?
The funds have gotten short wheat, and so they have a habit of pressing things, and I think they know that there's a lot of participants that have been trying to buy this market on the way down, especially when we tested $8 again, that's felt like a safe level to come in and step into the long side. So they're in here to punish, and they're doing a good job of it right now. Now, later in the month, we will be seeing a renegotiation of the grain corridor. Hopefully that gives us a little bit of upward volatility, especially if there's talk that Putin may renege on it or what have you. But I do think that if we get a move to the upside on wheat here in the next 2 to 3 weeks, that producers should be looking at a way to put a floor in under their crop.
I want to ask you, because you had an opportunity, Jacob, as you've been talking to folks, has there been any concerns about the discussion on this wheat market as it comes out of dormancy and what we could see if things don't green up like we hope?
It's funny you ask, because I had some people just stop by the booth here from Amarillo and Dalhart area and that panhandle part of Texas, and yeah, to say people are pretty scared about soil moisture in that area is a very accurate statement. So I think that talking to these wheat producers that we've talked to, I think that they have some optimism just because we've taken so much out of it. But right now the market doesn't have a lot of fear of inflation. Right now we're worried more about what we have done from from an interest rate standpoint to spark more deflation in it. So I think that's from a fundamental perspective of what's going on. Yes, we broke the charts. The funds are exiting long positions, and in the wheat market, pushing the market lower with continuous sells. But I think that when the wheat comes out of dormancy and what's actually there, is there going to be enough fear, enough scare in the market to help it rebound? And that's the fundamental reason maybe we can get some type of bottoming in this format in this wheat market.
You did talk a little bit about the Feds and that whole inflation talk. Kind of what's your spin on what happened this week? And it's going to set the tone for a while.
I believe whenever the threat of faster interest rate hikes, I think that put a damper on these commodities. That's where they have came in, the funds that came in and put a position of inflation hedging, if you will. And now when that fear of deflation starts to ring, whenever we start raising interest rates, I think that helps sped up the process. And then when we broke a lot of charts that Brian can talk to you about, the technical support levels were broken, and that just fueled the fire to some of this deflationary thought process.
I think he's launching the basketball to you on that one. What are your thoughts on when you look at the overall charts and that whole discussion that happened with the Feds?
So one of the things that I've been looking at, and we showed this at our conference in Nashville about a month ago, the commodity indices, and so you could look at Reuters Commodity Index, Bloomberg Commodity Index, and so one of the things that I showed is the Bloomberg Commodity Index had a uptrend that was established in 2020 after COVID lows were made. and we peaked out in commodities as a whole in spring of 2022. On the chart of the index, you would have what you would call a descending triangle. We had a good base of lows that were made in summer. We had another base of lows that were made in fall, and we took out those lows here recently. So that suggests that the commodities are now in a downtrend. That doesn't mean that they can't bounce, but that bounces should be selling opportunities. And one of the things, as we look at the increase in rates, the Fed talking about rates going higher than they thought they may have to go, maybe going up faster than they thought. And we also look at the M2 money supply. And if you look at the idea that as money supply increases, that inflation will go up with money supply, we are seeing M2 money supply contract drastically, and that is a very deflationary force.
All right, we had a gentleman in the audience. I was hoping we could get, I think it was Nathan that asked the question, but he doesn't want to come up and ask it. Do you want to come up and ask your question directly about December? No? Okay. So he is camera shy. So, of course, the opportunity here at Commodity Classic, and we're on the trade show floor, it means you guys are getting folks coming up wanting to get your thoughts. And even if the good, the bad, and the ugly on this December new crop?
So I think it's ugly. The December new crop contract had a very well-defined downtrend, a descending triangle on the chart, much like the commodity index itself. And so we've broken down of that descending triangle. And so I've been comparing a lot to 2013. There's a lot of similarities, whether it's making highs for the year, the first trading day of the year, being at 590 to start the month of February, breaking into the later part of the month of February. So something I do think that we could see happen is a little bit of a relief rally going into the end of the quarter as we get close to the planting intentions report. We do still have tight old crop stocks. That report will have a stocks report as part of it. So I think based on the break that we've had in 2013, we did see a low that was made the week of the WASDE report, which was this week. So I'm looking for a little bit of upward mobility as we finish out the month, but I think the producers should use that as a marketing opportunity to do catch-up sales, buy puts, whatever they need to do. And then on top of that, long term, these charts do project down into the low fours, and if we do see the balance sheet change the way I think they could, we're going to be looking at nearly a 2 billion bushel carryout with 91 million acres and a good yield.
So that kind of brings me, Jacob, over to you, the fact that there's a lot of guys that got grain still sitting in the bins from 2022. They should have been doing some marketing plans on that a long time ago.
I joked with the guy earlier that he had a lot of grain still in the bin. That's he must not have been working with us. We were pretty adamant early to be aggressive, making some sales, and even with the guys that do have grain in the bin, maybe they were waiting on different logistics or different reasons for having it in there. To be very encouraging for them to go ahead and have some type of floor in this market. It's really hard with this type of pricing and these opportunities that are out there to not have some type of protection in place. But the one thing you got to look at is what is it actually costing them to store this grain now? That is the way they're not operating on 3% interest rates anymore. They're operating, loans are probably more at 7 or 8, and to have those bushels still sitting in the bin at these type of profitability levels is probably not something I would recommend. Go ahead.
No, go ahead.
Well, I just look at what to do now, and that's the biggest question we've had now is, okay, we're here, we have some corn left to sell. At this point right now, the way that you asked what the picture looked like, the picture is not very pretty if you look at the chart behind us. And I would probably say from that picture, I don't want to make a lot of sales right here. I would much rather use some type of floor and hope that maybe we do have some type of planning problem or some type of news from the reports that are coming up at the end of the month that we can get a little bit of a bounce. So I would be very aggressive with some lower put strategies and leave the top side open.
Obviously, it's very important to have this conversation with folks like you and really have this marketing plan in place before that planter even hits the field. But as it's especially this year, are we going to get too emotional with this crop?
Yeah, Susan, I think part of the issue with this year is just the sheer amount of dollars it's going to take to grow the crop. And we look at the spring price average that was made in February, and it was $591, and it was $590 last year. So if you just say, oh, well, that's great, it was a touch higher than last year, but there's a major difference, and that this crop is going to be substantially more expensive than last year's crop. So $591 this year is not as good as $590 last year. And so I think that's one of the major concerns that we're hearing from producers that are coming by the booth is just the sheer amount of dollars that it's going to take to grow the crop this year. And so I think you have to look at that, and when you have the ability to do something management-wise to provide a floor that leaves you profitable with the flexibility of being able to capitalize on a rally should it occur down the road. That's how you want to set yourself up for success.
And no surprise, we're going to see, and I'll talk to both of you about this, but some serious geopolitical pressures happening in this marketplace.
Yeah, whenever you throw concerns about China in the mix, China's a large customer of ours, obviously, in soybeans. Over the last couple of years, their purchase power of corn has come in after we made substantial lows after COVID. And I think right now the market's trying to figure out what China needs year to year for corn. Prior to African swine fever, before changing their feed rations, they were buying maybe 1.5 million to 2 million tons of corn a year. Now it's substantially more than that. But they probably bought more in 2021 and 22 than they need to buy every year moving forward. So I think we got to figure out what that number is. But if we see additional or geopolitical tensions with China, that could weigh on the futures market just for concerns that they may not won't buy from the U.S. as aggressively as they would if we had good relations. In
a nutshell, you got about 30 seconds. What's your thoughts on the geopolitical world for grains?
Well, I think you look at not only China, but you got other areas such as the grain corridor, and if that gets passed, and I think that right now, if you wanted to look at the most urgent thing that we're looking at is, does that get past this in the next week, whether we're going to be able to continue to export grain out of Ukraine. I think if that is any type of problem, any type of halting of that could be beneficial for this wheat market. But if they do get that passed, this downward trend could continue in the wheat and maybe even in the corn a little bit.
Real quick, how do they get a hold of you guys to have this conversation?
Hey, first of all, look at agmarket.net. Take a 30-day free trial of our Intel, and from there you can find the numbers to all of our brokers on our website.
Wonderful. Thank you to both of you for joining us today. Of course, we've been on location at Commodity Classic, which is underway in Orlando. And as we always remind you, commodity futures and options do involve a substantial risk of loss not suitable to all investors. And that's been a look at the Nebraska Soybean Board's weekly market roundup on the road right here at Commodity Classic on the Rural Radio Network.